Hello, everyone. This is Cathy Seifert. I'm a Vice President in the Equity Research Group at CFRA. And today I wanted to discuss with you a piece of research we recently published on the asset management industry, specifically private equity. And we titled the piece Down But Not Out. Year to date through the end of the third quarter, private equity firms have been some of the worst performing names in the financial services sector, with the entire group down more than 35% through the end of the third quarter. Despite this, we still have a long-term positive outlook on the space because we feel that the near-term pressures, largely due to a rise in interest rates, belie some underlying positive fundamental trends, including some favorable fundraising trends, coupled with several long-term powerful trends that we see providing the shares in this group with a catalyst. And specifically, we see a combination of solid fundraising, a increase in the use of perpetual capital sources, and something that we would call the democratization of private equity, providing shares of some of the largest publicly traded private equity firms with some powerful catalysts. Before we begin, let's just frame our discussion by looking at the four components of the private equity process. The first one being the fundraising stage, the second being the investing stage. From there, we work into the asset appreciation stage, and then ultimately the exit stage, where investments are monetized. And so far this year, fundraising trends remain very healthy despite a more difficult macro environment. And as figure 2 in our research highlights, year to date, private equity firms raised, year to date through the end of the third quarter, private equity firms have raised over $672 billion of new capital. And while this is below the record level of almost $900 billion raised in 2021, this still is a very healthy, robust level of capital inflows into firms. Now, there are literally hundreds of private equity firms operating throughout the world today. Our focus is on the handful of the largest publicly traded private equity funds. And those results for those firms are also sort of best in class and continue to remain strong despite a more difficult operating climate. And so what we see is Blackstone continues to be at the top of the pack, both in terms of actual fund flows and fund flows relative to AUM. And so year to date in 2022, Blackstone over the trailing 12 months brought in nearly $340 billion of new capital on an AUM base of about $940 billion. So that's an enormous amount of organic growth, and we think that should provide the shares with a catalyst. Just behind Blackstone is KKR, that's also done what we view as a very strong job at fundraising. And for the trailing 12 months, they brought in nearly $100 billion on an asset base of just under $500 billion for a fund flow to AUM ratio of just over 20%, also very healthy. Apollo has also really picked up fundraising and has also really increased its sources of permanent capital, and they produced fund flow to AUM of over 21% in the trailing 12 months. The one laggard in this group, and the one stock that we have a neutral fundamental opinion on, is Carlyle Group. And we'll discuss more in more detail some of the challenges at Carlyle, but those challenges have manifested itself in a more challenging fundraising environment. And Carlyle only brought in $52 billion, a fund flow to AUM ratio of just under 14%, still very healthy when you compare it to traditional asset managers, but lagging some of its private equity peers. These solid fund flow trends have also allowed these firms to grow their AUM at a compound annual rate that exceeds that of the overall asset management industry, which is also why the valuations of private equity firms trades typically at a premium to those of traditional asset managers. And just by example, Blackstone's 5-year annual compound annual growth in assets under management exceeded 15%. KKR's exceeded 20%. And Apollo's was also just over 15%. This compares to some of the traditional asset managers like T. Rowe Price, whose assets under management have grown at a compound annual rate of just over 5%, and Franklin Templeton, who's boosted its growth through acquisitions, but still has grown its AUM at around 12 to 13%, still below that of the private equity firms. One of the trends that we're seeing in the private equity space is an emphasis on perpetual capital, which basically means having a captive capital base to reduce the firm's reliance on fundraising. And so while these firms have excelled at fundraising, at the same time, they're also shifting to a capital base that is more concentrated in perpetual capital, or in fund structures that don't contain the drawdowns, the capital calls, and the exit strategies, and the other less liquid features contained in traditional private equity funds. And one of the ways that private equity firms have done this is to increase their exposure to the insurance industry. And the forces that brought these two firms together are multifaceted, but the one primary factor that has sort of catalyzed this combination of firms has been a prolonged low interest rate environment that pressured insurer margins, particularly in long-term obligations like annuities, long-term care insurance, and things like that. And over the last several years, a number of insurers, including Allstate, American Financial Group, and most recently, American International Group, have determined that their life insurance and annuity businesses were not central to their long-term strategies. Many firms shed these businesses. Private equity organizations were among the primary acquirers of many of these life and annuity organizations, and many of the top private equity firms have, as part of their ownership structure, life and annuity companies that provide them with sources of permanent capital. And one way to assess the degree to which these firms are exposed to private capital is to look at the percentage of perpetual capital as it relates to a private equity firm's entire capital. And we note that Apollo has the greatest percentage of perpetual capital relative to total capital, largely due to its acquisition of Athene. So Apollo really has morphed into as much of an insurance company and an insurance asset manager as it is a private equity firm. The strategies taken by private equity firms as it relates to their insurance exposure have differed. And as we said, Apollo has the greatest exposure through its merger with Athene, an annuity writer, but previous transactions at Apollo also include a number of Bermuda-based reinsurers. So Apollo is at one end of the private equity insurance matrix at the higher end. Blackstone has not had the same ownership structure of its insurance asset management businesses, but Blackstone has aligned itself with a number of insurers to provide asset management services to these insurers. Most recently and most significantly, Blackstone has aligned itself with AIG, as AIG recently completed its reorganization that included the spinoff and sale through an IPO of its life and annuity business. Blackstone is a significant partner in this. They have an equity stake in Corebridge, the life and annuity unit. Executives of Blackstone sit on Corebridge's board, but Blackstone's ownership of outright insurance entities is less than, say, those of Apollo. And then at Carlyle, Carlyle has almost a 20% equity interest in Fortitude Re that it acquired several years ago. That has formed the cornerstone of their insurance solutions group. Earlier this year, Carlyle acquired the controlling interest in Fortitude Re, and we expect that that will be a vehicle for Carlyle to offer liability funding, reinsurance, portfolio construction, and asset management services to reinsurers, including Fortitude Re. And then finally, KKR expanded its exposure to the insurance area and its share of perpetual capital through its acquisition of Global Atlantic about a year and a half ago. They serve as the investment advisor to Global Atlantic and will provide asset management services to the annuity and retirement products currently underwritten by Global Atlantic. Not only do private equity firms have differing strategies as it relates to their sourcing of perpetual capital and the degree to which they have embedded themselves in the insurance industry, what we've seen over the last several years has been a shift in strategies in their deployment strategies, or how they invest the funds that they raise. And a review of the assets under management by segment point to Blackstone being the most diversified. However, Blackstone in recent years has made a big push into real estate, which now comprises the most significant percentage of its assets under management at 34%, while Apollo is probably the least diversified, and they divide their investments as yield assets, hybrid assets, or equity investments. And on this score, Apollo is the most exposed to yield assets or fixed income assets. Understanding profit measures in private equity can be a challenge because there's a significant difference between GAAP earnings, operating earnings, and an array of measures in between. We and most other analysts on the street measure profitability on the basis of distributable earnings. It's a non-GAAP measure, but it basically looks at the sum of operating profits across all segments, taking into account compensation expenses, interest expense, and other operating expenses. We think that is the most stable and reasonable way to look at these firms. However, we would caution that distributable earnings exclude mark-to-market valuations, which are the realized and unrealized gains or losses on assets. And so while GAAP earnings tend to be very volatile, but also reflect the true asset value of a company, distributable earnings give a better sense of the underlying operating profitability of the firm. And again, we're also seeing a little bit of a shift among companies shifting away from a fee-driven revenue and profit stream to more of a spreads-based profit and revenue stream, largely due to their shift into permanent capital and their increased exposure to the insurance business. And this fact is very prevalent at Apollo. Blackstone, again, the largest, the most diversified, still has a fairly diversified revenue and earnings stream, but in recent quarters, what we're seeing is an increased exposure to commercial real estate, which is driving the bulk of earnings, segment distributable earnings for Blackstone, with private equity coming in second behind their real estate operations. At Carlyle, the business model remains primarily one of a traditional global private equity firm, and their distributable earnings and revenues reflect this trend. 81% of their most recent distributable earnings were derived from their global private equity business. At KKR, they too have had a shift to a more fee-based revenue model, and in their most recent earnings statement, asset management fee-driven businesses represented 89% of distributable earnings. So we've discussed fundraising trends, which remain healthy. We've also discussed the different strategies that these firms have employed through the most recent cycle and heading into what will likely be a challenging environment in 2023. However, the offset here is that while asset valuations are likely to remain under pressure, the combination of significant fundraising has left many of these firms with significant amounts of dry powder, which is a colloquial term for capital that has been committed to a private equity firm that has not yet been deployed. And so many of these firms are heading into 2023 with significant amounts of capital that they will be able to deploy at valuation levels that remain very attractive. And so our belief is that the sell-off in shares of private equity firms that has occurred so far in 2022 belies some very favorable underlying trends that are being bolstered by favorable fundraising and asset inflows, and enhanced by a number of strategic shifts that have been executed by these firms, including a pivot to insurance and investment services. And while not without the challenges being brought on by a rising interest rate environment, we at CFRA believe that the private equity firms highlighted here, including Blackstone, Apollo, and KKR, have very favorable long-term prospects. And as a result of their weak year-to-date share performance, we view these shares as undervalued versus historical averages, and recommend that if investors would like additional information about anything we mentioned in this recording, please refer to MarketScope Advisor. Thank you.